So good morning everyone. I'll be presenting the case of Crookes Brothers Limited versus SARS, or the South Africa Revenue Services. So the facts of the case are Crookes Brothers Limited is the resident company which produces a variety of agricultural products in Southern Africa. And it has a subsidiary called Morimo Macadamias Limitada, which it owns 99%, and it's involved in the production of macadamia nuts. So what happened was Crookes, the parent company, advanced a loan to MLM, which is to fund the establishment of the macadamia farm that the subsidiary wants to establish. So it made or it advanced a total of $13.8 million dollars of loans to Crookes. We'll discuss the contents of the loan agreement later. So what happened was, after the loan was advanced, MLM made transfer pricing adjustments to its income due to the arm's length principle. So it made an adjustment to its taxable income, and it also made an adjustment and imputed a deemed dividend in specie to its taxable income. Because if you look into the transfer pricing rules in South Africa, there are two adjustments to be made in case the loans is covered by the transfer pricing rules. So what will happen is that if an income is derived by a company, wherein it would not have derived it if it was not independent, then adjustments to the income should be made. So that's at the very least the transfer pricing rules. The second adjustment would be that the benefit that the that the resident company would incur would be deemed as a dividend that is declared by the foreign subsidiary to the resident parent company. So there will be two tax implications in South African transfer pricing rules. So not only will they be taxed an additional tax for the additional taxable income, but the declared dividend would also be taxed if ever the transfer pricing rules would kick in. So after MLM made TP adjustments to its income, MLM then requested for a reduced assessment because they may have missed that they were exempted from the transfer pricing rules. Because if you also look into the transfer pricing rules in South Africa, there is a carve-out provision wherein there would be a case when the loan is actually an equity injection to the foreign subsidiary, then it would not be covered by the transfer pricing rules. So the requirements for the carve-out is that the resident parent must own at least 10% of equity shares in the foreign subsidiary, and that the loan is unredeemable within 30 years after the loan was given. 30 years, yes. You can.
Is it arm's length 30 years?
And that the assets, before the loan can be redeemed, the assets should be greater than the liabilities, and that there should be no interest accrued on the debt. So this is the carve-out provision that the South African transfer pricing rules would deem necessary for it to be considered not a debt, but rather merely an equity transfer. So, however, so MLM argued that this all these standards were fulfilled by the loan contracts because the loan contracts contain all of these all of these provisions that it is unredeemable within a period of 30 years, that Crookes can only redeem the loan if the assets are greater than the liabilities, and that no interest is accrued by Crookes from the debt that it gave to MLM. However, next slide please. SARS denied MLM's request because the loan contract actually contains an acceleration clause, which makes the loan contract immediately due and demandable if MLM is liquidated or goes bankrupt or goes into business rescue or other proceedings, and if there was a judgment against MLM and it has not paid the judgment for a period of 14 days, then the loan would also be accelerated. SARS also denied MLM's another argument wherein MLM said that the loan agreements also contain another subordination agreement, in which case Crookes made its claims subordinate to the claims of other creditors in case the loan becomes due and demandable. In that argument, SARS said that the subordination agreement merely changes Crookes' ranking in the claims for the debts, and it does not make the claim not immediately due and demandable. So after that, the Crookes appealed the case to the High Court, and it said that the SARS was wrong to not reduce its assessment because of the grounds that it signed it before. It also SARS also argued that if you look into the grounds for the carve-out provision to kick in, the assessment must be made from year to year, meaning that you must look into every year in which an assessment is made and determine whether or not the debt is immediately due and demandable. And if within that current taxable year, the debt was not due and demandable, then they would still be covered by the exemption. However, next slide please. However, the High Court dismissed the case because it agreed with SARS, in which it said that there might be a situation in which it obliges the foreign company to repay the loan before the expiry of 30 years. So it looked into the nature of the transaction. Because the nature of the transaction is, there is an acceleration clause. So we should not look into year-to-year assessment, but rather the nature of the whole document. And if it says that it may be redeemed within the period of 30 years, then it's not covered by the exemption. It also said that the subordination agreement merely changes the applicant's ranking amongst the creditors of MLM, and it doesn't actually negate the acceleration clause that was contained in the loan agreement. So overall, the High Court looked into the contract itself, the wording of the contract itself, rather than the intention of the parties. I've looked into the case and the opinion of the legal expert within South Africa, and they commented that this is not a good precedent because the High Court looked into the wording or the letter of the loan contracts rather than the intention of the parties, because it was readily apparent in the loan contracts that they intended to follow the grounds for the loan contracts to be exempted from the transfer pricing rules, because they include provisions which covers all the grounds that it should be not redeemable within a 30-year period, that the loans have no interest, that that it can only be redeemable if the subsidiary's assets are greater than its liabilities. So it will comply with all the grounds. It's just that there is an acceleration clause that is also present that made it not covered by the carve out. There's also a warning here in which the lawyer should be careful in drafting the loan contracts because although it by default acceleration clauses are a standard or a template or boilerplate provision which is contained in all the loan contracts, but in this case this standard acceleration clause made the loan contracts not covered by the carve out. So in the end, it harmed the client more than it protected the client. So
Lawyer ka talaga.
that's the essence of this ruling. Although it's the first transfer pricing case in South Africa, it didn't actually deal with the transfer pricing analysis itself because there was really no discussion on transfer pricing, but rather the application of the carve-out provision of the transfer pricing rules in South Africa.